Did you recently get a call from a wealth manager offering a pre-IPO shares of a soon-to-be listed startup? A lot of investors get excited when the company is about to list. Whenever a company's DHRP is published and the IPO is expected in the next couple of months, wealth managers and the grey market dealers start pushing unlisted shares. The pitch usually sounds very tempting. Buy now before the IPO, you'll make listing gains. But this is exactly the stage where evaluation becomes most important because the price band isn't announced yet and the investors have no clarity on the final valuation. Here is how to assess whether you should enter a pre-IPO deal or simply wait for the listing. The first is start with the valuation. Is it overpriced or underpriced? Most pre-IPO deals are priced at very aggressive valuations because the demand is high close to the listing. So always compare first the grey market valuation versus listed peers, then the PE multiple, revenue multiple or customer-based valuation matrices. Whether the premium is justified based on the growth, profitability, and the market share. If the valuation is already richer than the listed competitors, it might be better to wait for the IPO. Second, understand the business quality, not the buzz. Ignore the IPO hype, focus on the fundamentals. Example, revenue growth, is it sustainable or not? Profitability, which accounts for actual margins, not the adjusted numbers. Cash flow, strong or consistently negative. Regulatory risk, could any rule change impact the business model? Dependence on one product or segment. If the core business is under regulatory pressure or growth is slowing, a pre-IPO entry is very risky. Third, analyze the IPO structure. This is very important. Before buying unlisted shares, look at the following. Fresh issue versus offer for sale, which is often known as OFS. How much money actually goes into the company? Whether early investors are exiting in the large volume or not. High OFS means that existing investors are cashing out. Low fresh issue means the company is not raising enough growth capital. This is exactly why many investors stay cautious in the pre-IPO rounds. Fourth, check for lock-ins, liquidity, and exit risk. Buying pre-IPO shares is not same as buying the IPO, so you need to check if there is a lock-in, whether the transfer is compliant under the Companies Act, who will provide the liquidity if market turns volatile, whether there is clarity on shares, transfer timelines or not. Pre-IPO equity is illiquid. If the IPO gets delayed, you are stuck. Fifth, evaluate whether waiting for the IPO is smarter or not. Sometimes entering a listing is safer because you get full disclosure, you know the final issue price, you can see the subscription demand, you can compare valuation versus listed pairs in the real time, you get liquidity from day one. Many great companies have been listed at a sensible price even after pre-IPO shares traded in the higher informal market. Some recent examples include Grow, Meesho, Lenskart, and Pine Labs, all of which were available in the unlisted market at a 20 to 30% premium compared to the price they were listed at. This is the classic grey market risk. You pay a premium without knowing the final price band. Pre-IPO deal look exciting, but they come with illiquidity, uncertain timelines, no price discovery, regulatory vulnerability, overvaluation risk, transfer and documentation risk, etc. So enter pre-IPO deals only when the valuation is reasonable, fundamentals are solid, and you're comfortable with longer holding period. Otherwise, waiting for the IPO is often a wiser move. Thank you.